Welcome to MarketPeeker. In today's episode, we're going to explore Forex trading and how it works. If you've ever heard of people making money by buying and selling currencies, that's Forex trading. But how does it actually work? Let's break it down. The Forex market, also known as the foreign exchange market, is the largest financial market in the world where currencies are bought and sold. It's open 24 hours a day, 5 days a week, and allows traders to exchange one currency for another. For example, you can trade euros for dollars or pounds for yen. Every time you travel abroad and exchange currency, you've technically participated in the Forex market. Forex trading happens in currency pairs. This means you're always buying one currency while selling another. The first currency in the pair is called the base currency, and the second is the quote currency. For example, in the pair EUR-USD, the euro is the base currency, and the US dollar is the quote currency. The price of the pair shows how much of the quote currency you need to buy 1 unit of the base currency. The Forex market works through a decentralized network of banks, brokers, and individual traders. This means that unlike a stock exchange, there's no central hub where trading happens. Instead, it's a global market where transactions are done electronically, over the counter, OTC. This allows traders to access the market at any time during the trading week. When trading Forex, you'll see two prices: the bid price and the ask price. The bid price is the price at which you can sell the base currency, and the ask price is the price at which you can buy the base currency. The difference between these two prices is called the spread, and it's how brokers make their money. In Forex trading, you can also use something called leverage, which allows you to control a larger amount of currency than what you actually invest. For example, with a leverage of 100, you can trade $10,000 with only $100 in your account. But be careful. While leverage can increase your potential profits, it can also magnify your losses. Another key concept is pip. A pip is the smallest price movement a currency pair can make based on market convention. It's usually the fourth decimal place for most currency pairs, like 0.0001. Understanding how pips work is important for calculating your profits and losses in Forex trading. Forex trading is affected by many factors, including economic news, political events, and global market trends. As a trader, you'll need to keep an eye on these factors to make informed decisions. Many traders use technical analysis, fundamental analysis, or a combination of both to predict market movements. In summary, Forex trading involves buying and selling currencies in pairs, using leverage to increase your position, and paying attention to market conditions and news events to make smart trades. With its high liquidity and flexibility, the Forex market offers plenty of opportunities for traders around the world.